Okay, well, welcome everyone. I'm just going to give a few moments here while we see the attendees coming in, and we'll get started shortly. Okay, well, hello everyone, and welcome to How to Grow Your Mortgage Book panel hosted by the Canadian Lenders Association. We have a great group of panelists today and a really interesting discussion moderated by Adam Merrick, a partner at MLT Atkins. Adam's going to take us through the panel discussion, and then we will be accepting questions live. So please remember at any time you can submit your questions on the Q&A button there, and we'll try to get to them after the panel discussion. And as always, this panel will be emailed out to you. The recording of it will be emailed out to you afterwards, so you can rewatch it in your own time. And I also wanted to give a huge thank you to our sponsor for this panel today, Mortgage Automator. But without any further ado, I'm going to pass the mic over to you, Adam, to get the panel started.
Okay, thank you very much. Hope everybody can hear me clearly. Today's topic, we've got a great panel that I'll be introducing here in a second, but in this webinar, we're going to discuss trends and concerns for the mortgage sector and provide recommendations on how technology and innovative business practices can drive growth in your mortgage portfolio in the next 2 to 5 years. Especially with rates expected to move, i.e. go up here in the near future. There's going to be some change in this industry over the next couple of years. So in terms of our panel today, and again, my name's Adam Merrick, I'm the moderator. I'm a partner with MLT Atkins in Edmonton, Alberta. We're essentially a Western Canadian firm from Manitoba west to the Pacific Ocean, and we also serve the North as well. For today's panel, we have Joseph Fuchs, a co-founder of the Mortgage Automator. And Joseph, if you want to introduce yourself and sort of tell everybody what you do, that would be great.
Sure. Hi, everyone. Joseph here, co-founder of Mortgage Automator. We are essentially a loan origination and loan servicing platform for the mortgage space. Essentially, what we've done is built a platform to allow lenders to become more efficient in their day-to-day business with document generation, payment processing, accounting, and helping a lot of customers in Canada and the US essentially allow their business to become significantly more efficient.
Thank you, Joseph. Our next panel member is Chad Weniger from Snap. Chad, why don't you introduce yourself and tell us what you do?
Thanks, Adam. Yeah, my name is Chad Weniger. I'm the owner-operator of Snap NOA. Essentially what it is we collect tax documents for mortgage financing purposes. We started in 2016 as kind of a little, working with a few brokers here and there just to help them streamline their processes in collecting tax documents, which now has evolved, and we now have integrations with most of the mortgage origination platforms in the broker space with some CRM programs. We have some lenders that use our service as well. And it really just has to do with the speed and efficiency and compliance in that aspect of tax documents and making sure that you're getting the right information in the quickest way possible. I've also been a broker for 17 years, so I kind of go on both sides of the fence on this, where I kind of have some tech stuff helping in that aspect, but I'm also a broker that also still continues to grow a business as well. So I see what's happening on both sides. So
thank you, Chad. Our next panel member is Jesse Bobrovsky from Calvert Home Mortgage. Jesse, why don't you introduce yourself and tell us about yourself?
Yeah, hey there, Jesse Bobrovsky, Calvert Home Mortgage Investment Corporation. I am Vice President of Business Development and partner with the firm. What we do is we lend money out in the form of mortgages. We are laser focused on providing short-term solutions for the financial success of our clients. Short-term solutions, the bulk of our mortgages are getting paid out within a year. We love to work with real estate investors who buy, renovate, sell, buy, renovate, and refinance residential housing stock. We operate throughout Alberta and Ontario and are looking at some options to start lending in BC over the next year.
Okay, thank you, Jesse. And our final speaker or panel member is Alex Leduc from Perch. Alex, are you able to, Alex is sort of on a plane, so hopefully Alex is able to hear me and is able to introduce himself.
No,
Yeah,
absolutely. I
okay,
will.
great.
I'll get off. I'll enable the camera soon. My flight got delayed, so apologies, everyone. But essentially, I'm founder and CEO of Perch. We help Canadians optimize their path to home ownership, and then as homeowners, we help them build wealth. So I'm also principal broker of Perch. So we're a mortgage brokerage. Been in this space for about 9 years. I'm excited to be here.
Okay, wonderful. Thank you, Alex. So getting into our topic and our question, and I'll start with Jesse with the first question, which is, Jesse, what are you observing as the existing trends and concerns for the mortgage sector currently?
Yeah, thanks, Adam. We're observing a lot of trends. I was just speaking with a real estate podcast host yesterday, and typically he was releasing these 2 months after the taping, and now because there's so much going on in the industry, it's almost dated after 2 months. Some things we're watching as an organization, definitely inflation and the effects of. So the rising interest rate environment, trying to understand how that is going to affect housing prices, how that's going to affect inventory. Another big thing is affordability. A lot of homeowners are stretched, especially in the markets where we've seen some really major appreciation. Definitely cybersecurity is something big that we're watching as an organization. As a mortgage lender and an investment fund, we have a lot of very sensitive information, and we treat that with the utmost respect, and putting kind of safeguards around that, and making sure we have the right audit systems in place, make sure we're consistently testing is a very big priority of ours. Also, customer service and the client experience is what has made us successful, what has allowed us to scale and grow this company to where we're at today. And that customer is always looking for more. Today, it has a lot to do with speed, providing that effortless experience, making things easy. Oftentimes in this industry, where you're lending mortgages, there's a lot of paperwork. There's a lot of due diligence that needs to be done, and in turn, that can create a lot of friction. So how do we break down those barriers? How do we speed up the process? How do we automate the process for the benefit of the client? And then, of course, we're looking at various pricing and product lines to get into as the market changes, as we see rates increase. We know that at least in our alternative mortgage industry, the bigger players are using bank debt, so they're using leverage more than they ever have. So as rates increase for the banks and our lines of credit, how does that impact the client? How does that impact how we price the mortgages that we're looking to lend out on?
Thank you, Jesse. Chad, same question in terms of what are you observing as the existing trends and concerns for the mortgage sector?
Yeah, so I obviously echo a lot of what Jesse talked about, and some of the big ones that really come out are a lot to do with the cybersecurity and just the speed and efficiency and the automation that's been embedded into the mortgage industry these days. COVID a couple of years ago was a pretty big thing that rolled the whole world on its head, but at the same time, as an industry like the mortgage industry, in some aspects, it actually helped everyone, because everyone was kind of working towards really just got sped up a lot, in the sense of the automation and a lot of these consents. And when you think about like the whole privacy, security, and cybersecurity and all those types of aspects, there's a lot of people now these days that are, I think about this in the consumer perspective, and you go talk to a broker and all of a sudden you're filling out an online application, and then this consent form comes in over here, and then this consent form comes in over here, and then you got to sign this one on the back end, and we're going to collect your tax documents, we're going to collect your bank statements, and all this stuff is now completely automated to the point where like there's some people that are really scared about it. But I think at the same time, as a broker, it's something you can almost embrace because it allows you to put more aspect on the customer service side than the whole day-to-day, like chasing people for documents and that kind of aspect. Because even when you think about all this stuff being embedded in the customer side, it is also mutually beneficial on the lender side as well. Because I mean, 17 years in the industry, you think like back in the day, you used to get a mortgage commitment and then you started working through the conditions list. And now all of a sudden you have to submit the mortgage application with a full conditions list. So that helps lenders to come to quick decisions, to use things like AI and things like that within these systems and platforms like Joseph is building and all this, to like really find those pain points, really bring out all the, maybe some of the red flags on deals a lot sooner than having a live person do it. It can be like a lot more automated. So a lot of the stuff that's happening now is really driven by tech and innovation, and it's good on all fronts, I think. But that's just because if you can embrace it and really use it as a broker, I mean, you can do 2 or 3 times more deals with the same output they used to do like 5-6 years ago, and the lenders can come to quicker responses, issue commitments quicker. And in our world of real estate, where everything's subject free and nobody has time to make decisions, it's the number one thing that really makes anyone stand out, is if they can really provide that extra customer service and go that extra distance. So.
Thank you, Chad. Joseph, I don't know if, I mean, assume you want to weigh in on this in terms of what you're seeing as existing trends and concerns in the industry.
Absolutely, Adam. So what we've had in the past with this market is a very low interest market. Bank rates were obviously, the Bank of Canada rates were at 0. Now they're going up for the first time in a very long time. So you've got companies sort of scrambling, trying to figure out what to do. Obviously understanding that, you know, as Jesse mentioned, people are borrowing or lenders are borrowing from bank facilities and using that as leverage. They were offering, even the privates were offering very low and aggressive rates in a market that never saw rates that low before, especially with the competition and the privates almost essentially creating their own market within the mortgage space. And with these rising rates, yes, there are concerns of borrowers having to have larger mortgage payments. Obviously, as these qualifying rates go up, there are concerns that they'll have to go to privates to borrow even at even higher costs. And then that becomes an issue with the affordability, utilizing the property as piggy banks. When does that music stop? And with rising interest rates, you tend to have slowdowns in markets. Now, Toronto specifically, which is where I'm from, we don't see those things, but I think that even in Toronto right now, what I'm seeing, what I'm hearing, speaking to my clients, you've got the market slowing down, and lenders who are used to having these very low rates are sort of all scrambling to figure out, do we stay low? Do we lose money on margin to try to bring in business? Do we raise rates? Is someone going to undercut us? So that's something I'm seeing in the market. And then, you know, to add to what Chad's saying quickly, yeah, I think the world has evolved very quickly since COVID. Connectivity to systems is extremely important today. Being accessible to brokers as lenders is extremely important today. To get turnaround on documents, on conditions is extremely important. And we're doing our part in trying to make that part more efficient. But we are definitely in a new environment, and it's going to be interesting to see how this all kind of turns out over the next few months and even next year or two.
Thank you, Joseph, and I agree. Lots happening, and it's becoming a very, very quick world. Alex, in terms of existing trends and concerns from your perspective in the mortgage sector, your thoughts?
All right, here we go. So I think, here we go. Now I'm off the plane. So just to echo a lot of the things that have already been said, that a lot of good points being made. I think there's a unique opportunity for brokers, especially to help their clients in moments like this, I find, because if you go back 2-3 years, the main goal from everybody was always like, I want the prime lending. I want to get out of whatever it is. Like, there was almost no other reason with falling rates to go anywhere else. But now you're finding this interesting dynamic where people still have the mentality of, I only want, like, let's say, and again, it's specific to our book, we deal with mainly prime borrowers. So, I mean, a lot of you might not have the same issue, but where it's happening now is that as you have this weighted average, it actually then becomes a better equation that you can add a lot more value to your client. when if they need maybe a second mortgage actually makes more sense than breaking your 1.9 5-year fixed mortgage and refinancing it into a 4.2. So when you have access to A product, B product, private product, there's now going to be a lot more of a multivariate equation you need to be solving for your client versus the standard, oh, you were paying 3, we'll break it, put you into 1.9, you paid 3 months interest, and it's almost always better. But now it's not the case anymore. And then also so that's more from a product pricing standpoint. I think the equation is going to change from a lowest rate to the weighted average components of kind of putting together the pieces. From a location standpoint, I think when COVID first started, the remote work craze kind of pushed up property prices and demand in a lot of remote areas. But I think a lot of people were really hesitant because they weren't really sure if this was a permanent shift or if this was just temporary with their employer. So now it's kind of, now that the dust has settled, a lot of employers have really pushed either a hybrid or a fully remote working environment. So now people are just ready to commit to going. I mean, I've had people move from Toronto to Calgary, Nova Scotia, et cetera. So this is really kind of pushing a lot of buyers out into areas where homes are more affordable for them and they're comfortable locking something down. And then whereas you're actually seeing the exact opposite in some cases where some people thought it would be permanent, turns out it wasn't permanent, and now they're rushing to get back into the city core. So there is a bit of I guess let's call it a flux that needs to balance out. I shouldn't take too long to correct. And the last thing is on customer service. So the expectation, a lot of my colleagues here echoed, so pricing is one thing, but also speed and functionality. I think one of the interesting things that a lot of lenders take for granted is just like consumers, especially the next generation of buyers, expect to be able to manage, see, and be informed on where their mortgage is, like within the palm of their hands. Like they don't want to have to wait on hold to get it, or even worse, like having to pay to get a mortgage statement sent to you by mail. Things like that just aren't going to be acceptable anymore. So people really have to look into like, how can I service my clients in an efficient way? And it's also good for the lender because then they can scale their operations and their mortgage servicing. So I think a lot of these things will become necessary for them to compete, but also even just to get clients in the first place.
Thank you, Alex. And this is great panel for some of your comments on the trends and concerns in the sector. Sort of moving forward, I mean, we know there's trends, we know there's concerns, and I guess my question is, and I'll start with Alex, I mean, what are you doing to adopt systems and processes that will help you become more efficient to deal with these trends and concerns and to assist with your growth of business over the next 2 to 5 years?
Yeah, sure. Yeah, so I'll maybe speak to 2 of them. So the first one would be process automation. So for a lot of the reasons that we were kind of just previously discussed, so we use automation in the sense of from a path optimization standpoint. So how do we look at, like, I call it holistic solutioning. So just being able to actually look at, hey, here's what you qualify for today is part one, but then it goes beyond that into how can you actually, so if you don't qualify for it today, what solutions can we put together? How can we prepare you to actually qualify for more at a sooner time? So sometimes it means going the extra mile, and it could be things like tax planning with your self-employed clients before they file their taxes, because if you miss it, then essentially it's 2 years that gets pushed out. So how do you catch those trigger points where essentially it's not making
Technical difficulties.
All right, all the doors are closed now.
Okay, no, fair enough.
so sorry. So essentially, so one thing. So yeah, so process automation. So we're looking at document automation. So like machine vision and things like that to review a lot of documents to speed up underwriting process. And then just to speak to the holistic solutioning, as I was just talking about, there's a lot of opportunities to really help clients along the way. So whether it's getting them into their home buyer's plan and then banking on the tax rebate as ways to increase their down payment, looking at talking to them at the end of the year before they file their taxes to look at like how much dividends have you paid yourself? How is it going to work as a self-employed client? Like going beyond the reactive standpoint and making sure those triggers are in place for our advisors to know when to reach out and when there are a bit more opportunistic moments to build trust in a relationship with our users, rather than just kind of waiting till someone like the deal's on your door before you decide to kind of really do anything with it. Because a lot of the times people need that planning to tackle the affordability component, because it's not as straightforward anymore where you can't just wake up and decide you're going to buy a house. A lot of the times you have to plan for maybe even years. to put the right motion in place.
Okay, thank you, Alex. Joseph, what are you doing on your end to adopt systems and processes that are helping you become more efficient to deal with these trends and to assist with your growth of business?
So I'll sort of repurpose the question a little bit, and I'll address it in a little bit different way. What we're doing as a provider to our clients to create digitization and obviously our digital platform, we're looking to help create solutions for our customers. Obviously, not being like I'm not a lender from the perspective of today's conversation. We're a software provider. We're looking to create connectivity solutions for our customers, being hooked into Filogix and Velocity and Finmo Lendesk, allowing brokers from any platform like Alex's office to submit to any of the lenders utilizing our platform to digitally ingest all that data safely, securely, including the credit bureaus themselves. Being able to generate docs with the click of a button to make the response time from lenders to brokers significantly much quicker, to be able to map all that to pulling payments. So we are doing everything from on our end to create these efficiencies, especially with COVID pushing that. As Chad said, it really accelerated all of that and forced us as a company to really accelerate our development for our consumers. Now, talking about artificial intelligence, I want to discuss that a little bit. The word is used very loosely, and I want to say that in the private mortgage space, maybe not in Alex's world, which is AAA business, but in Jesse's world, I think it's a very dangerous thing to fully implement into a business, only because if you want to rely on computers and machine learning to figure out whether that borrower is a good fit for a private mortgage, I think you might be out of business quite quickly. I can give you examples where if I built a system set that I don't want to do any deals less than no higher than 80% loan to value, and it has to be at least a 500 or 600 credit score, you could be saying no to deals that potentially are still very doable deals and that Jesse's company would write in a heartbeat. And I'll give you an example. Deal comes in at 90% loan to value, the machine learning system would auto decline it. But then all you have to do is have that person on that with that company call the board to find out the parents are willing to add their property as collateral, which is what privates do, right? We're here to create solutions for these customers that banks can't help them with, and finding out that property's, let's say, free and clear, and the deal ends up being a 50% LTV deal, and the parents are strong co-signers, that's a deal that system essentially auto declined, and now someone else has picked up. So I would say in the private space, I'm just talking about, my world, I think it's very important to still have hands-on people looking, reviewing, touching, speaking, building those relationships. I would say, the document automation processes, all that's obviously important. Receiving the data, not having to do manual importing, that's all key to a company's success and growth in today's world. But I still think we have to be very careful with the word AI and machine learning, because it's good in certain industries, but I think in the private space, we should be very careful. That's sort of my take on it. And what I'm seeing as well, most companies that start in the lending space today will automatically start looking for a software. They're not trying to build everything manually. And once they get overwhelmed and very busy, they then start looking for a software. That was the case 5-6 years ago. Today, I'm noticing a very different trend where people will call me and say, I'm starting a business in 2 months. I was told you guys are the software provider we need to talk to. We know a lot of clients are using you. We need to build our business on this foundation from day one. So that's that's a trend I'm seeing. And clients are looking to automatically build businesses on a proper digital foundation rather than doing it manually. So that's sort of my 2 cents on it.
Thank you, Joseph. And definitely the person-to-person interactions is very, very important, especially coming out of COVID too, where a lot of us have been sort of in prison, might be, I don't know if that's the right word or not, but in some cases that may be the case. But thank you for your thoughts on that. Chad, what are you doing to adopt systems and processes that will help you become more efficient, to deal with these trends and concerns and to grow your business in the near future?
Yeah, so for us at Snap, we do a pretty simple, easy process. We do kind of have one product on our shelf, which is tax documents. But it's really the delivery of all this and like the speed and efficiency that we have that kind of like keeps us, what I feel is kind of in the forefront of a lot of the mortgage industry's mind these days. And in the last year, we've actually been developing our own technology as far as like, because snapping away, like, there's other tax document retrieval services out there in the world. But I always explain to people, like in some aspects, we're like kind of pioneering this new way. It's not like, Joseph has a great product, but if I was to say like, I want to use you for mine, it's like, well, we do completely different things. So it may not work for me just because we have like a system and process that we follow. We have the certain softwares we need to use. So we're really trying to, a lot of the stuff that we're doing and a lot of is really the data analysis. Like we are a software as a service for a lot of brokers in that aspect because we collect the tax documents, but it's like, what are we doing with that data once we have it? Like right now we're passing the information off to the broker, the lender, whoever's using it at the end of the day. But it's trying to figure out what the new normal is because I talked to some lenders and some underwriters at banks about what we do. And they tell me flat out that they may not know that the broker used our service to collect tax documents, but they know the broker used our service to collect tax documents. So how do we make what we do industry normal so that when the information gets passed to the broker and then onto the lender sees me like, oh, this came from Snapping Away. Like, we love this stuff. It's awesome. And they want to use it and they want, it's a quick compliance issue for them. It's like, sign off on it. And then really it's just creating a lot of that for us, like the system and the process that we've created is just how do we connect those like connections to systems and softwares. Joseph mentioned some of the ones in our world, like the Velocities, the Finmos, the Boss, the DOS, the Filogix Pro. Like we essentially have connected to 4 out of them already, where it's how do we create that system and process within the system where a broker can just click a button and all of a sudden, as quick as it is to order tax documents, as quick as it is to order a credit report, we can get the tax documents just as quick. So now it becomes like we guarantee a 24-hour turnaround time, but if we have our system and process dialed in on our side, like how quickly can we turn this around? Whereas sometimes a broker calls us and asks us how it could be so quick because they clicked the button and 10 minutes later they had 2 years NOAs, T4s, T5s, proof of income statement, statement of account sitting in their file. And it was like 10 minutes ago they placed the order. And how do we mimic that and make that normal every time? And that's really a lot of stuff that we're doing. But then on top of which, like we are passing, like when we first started at Snap, like a broker would place on average 5 orders a month and we'd send them the 2 years NOAs because that's all that was available through CRA. Now they've added so many updates and it's so robust now with a lot of the information. Like we could send people, I think one broker, we actually sent them once like 80 different PDFs. So no different than a lender underwriter doesn't want to actually like look at 80 different PDFs. How do we take that data out and bring to the forefront all the important stuff so that you're not just looking at an NOA that says, oh, they made 250,000, but they sold a property, they took some RSPs out, all those types of things. Sorry. So now it becomes like, how do we piece that data out to give them a nice readable format that they know exactly what they're getting every single time and take all the guesswork out. So we're thinking a lot about the data analysis of it and how we pass it to the broker in a simple, easy format, just to speed track it. If we can save the broker 15 minutes on a file, that's a win for us. So that's a lot of the big things that we're really working on. So, yeah.
Thank you, Chad, for your comments. Jesse, what are you doing on your end to adopt systems and processes that will help you become more efficient to deal with these trends and to help grow your business?
Yeah, so innovation has been a huge piece of our strategy over the last 5 years. Especially, we've identified that the world is going in a way where things are automated, things are made easy. Data is there to be leveraged and utilized. And the companies who are best leveraging and utilizing data are the companies who are going to be around for the next 5, 10, 15, 20 years. Those who are not paying attention to what is available to them, it's going to be tough to survive. So we've had a strategy around innovation for the last 5 years. We have a we have people within the organization that are specifically focused on innovation. We have a VP of projects and innovation. We have a change management consultant. And really what we're trying to do is think of how do we make, we're thinking of a lot of things, but one thing we're thinking of, how do we break down organizational silos with our systems? There's a lot of amazing software as a service out there, from your CRMs, your Salesforces, your HubSpots. There's a lot of ops systems, like what Joseph has at Mortgage Automator, also mortgage administration software, also accounting software. So when you're feeding information into 4, 5, 6 different software systems, how do you holistically look at the organization and have these things talk to each other so that you could model out, forecast? Joseph mentioned machine learning and AI. I would agree that machine learning and AI on the underwriting side, in some instances, may not be optimal, but certainly when you when a mortgage lender is using their data in terms of understanding what deals are getting accepted, what deals are getting declined, what deals are going into arrears, what deals are going into foreclosure, and what are the variables that play there, that's where we believe machine learning and AI is critical. Machine learning, though, also on that data analysis can then serve your underwriter. Like, our underwriters are amazing client service representatives. They're out there. When they're on the phone, they're at their best. When they're finding solutions, they're at their best. So how do we limit their time in the admin and the paperwork? How do we automate everything? How do we also give them those data insights when they're plugging in, let's say, for instance, credit score plus income plus location plus loan to value? We want systems to say, hey, this has an X% likelihood of getting approved. When we have our underwriters going full bore servicing clients, maybe they can select out, hey, this one has a really low shot of getting approved. I'm going to push it down to a junior person to handle. So just using that data to give the business insights, and to it's really providing a better customer service, but it's reducing risk in a major way for us. It is giving our shareholders and stakeholders on the financial side a lot more confidence when they're dealing with us. We're able to dashboard things that they want to see. Like, for instance, right now I can know how many loans I have in Northwest Calgary. If I wanted to segment it into second mortgages, I could find that out. I could find out the average interest rates for that. I can find out the default rate, how much money we've lost there. So being able to leverage data is critical from our standpoint, and with how we are strategizing going into next year and the next 10 years.
Thank you, Jesse. So I'll start with Chad here. Chad, I mean, how are you adjusting your product mix to deal with interest rates that are expected to move upwards in the future? And I appreciate your business may be a little different here. So
yeah, I don't borrow any money, so thank God. But I mean, yeah, we're always looking at like how we can better the broker experience and like really take what we're doing and like bring it to the next level. Which is why, we've developed our own software, things like that, which allow us to manipulate kind of the information we're receiving and getting. But really a lot of like the stuff that we're looking at when we think about the next product level, we do compliance packages, we do compliance documents, like what other need is there in those types of aspects? And like I mentioned earlier, some of the stuff that is like, how do we piece out this data that we're getting? We're sending these full-on tax packages to like all these, like to brokers and lenders and all over the place. We have multiple benefits as far as the speed and efficiency of retrieving the data, but obviously like as a lender, like they know that like, well, this information came directly from CRA. Like most lenders and most credit managers I talk to don't really have an exact stat on it. But most of them say that 40% of the fraud they have on their desk comes from income. The other 40% comes from like down payment verification. So if the majority of that comes from like those types of things, how do we help them minimize that and essentially just get the fraud files off their desk altogether? Because if it does come from tax documents, well, we pull information direct from CRA and we can piece this out. And what did they say they had here? Like, so it's really about how we provide the information to the lenders in a quick and easy way, but also the broker. And like I said, like being able to parse out some of that data and figure out that, like, because obviously there's only usable income when you really break it down on a mortgage application. So how do we just take all the guesswork out of it, and how do we automate some of this stuff where broker places an order, we give them all the tax documents, but then we can tell them what the 2-year average is for a sole proprietor and where their income is, and here's your gross up and all these different ways, so they don't have to do the math. Because again, if we can provide a software that does that for them, here's the compliance package, here's the important numbers you need to know. I mean, we could have essentially saved someone like an hour to 2 hours on a file. And now they can go do twice as many files in that day, right? So that's when we're thinking about products and how to expand our shelf, that's really kind of the stuff we're looking at. We have all this data at our fingertips, and what are we doing to really utilize it to make the brokers and the lenders' lives super simple, super easy, and here you go, pay your whatever, however many dollars for it. And most people are happy paying it because we provide that such a great service for it. So.
Thank you, Chad. Appreciate that. Alex, how are you adjusting your product mix to deal with interest rates that are expected to move upwards in the near future?
So I think for us, it's really along the lines of just building on the optimization techniques that we already have. So for us, for example, it's going from prime, and this would actually probably be a really good use case for things like machine learning, is when you take a user, you can simulate what those next couple of years look like. So is their income going to appreciate? What's their savings accumulation look like? What's the property appreciation that they want to go after? And then how do you overlay, if they go B first and refi out in a year, are they going to qualify? If they go 2 years, like how much time do they need to actually be an A client or be a B client? Because a lot of the times it works into, it's no longer like you just get you go straight into A like at the beginning anymore, because there's a lot of housing affordability, and then interest rates rising also make the payments harder to service. So we're looking into how do we make better solutions that, one, enable our brokers to be able to compare all those options very quickly. Because the right way to go with the client shouldn't be that, hey, let me go run these various models and I'll get back to you in like a couple hours, because there's so many different simulations you could do. So how do you actually have it be done in a path optimized way where you're using technology to actually like optimize it for you? So it's like, hey, here's the best path, here's the assumptions that you made, and then you can change the assumptions and see how the path varies. So that's going to become more and more important. And then the ultimate goal should always be like, how do you truly help your client the most? So you need to be able to quantify it. Because a lot of the times it's going to be an educational component. So how do you convince someone to go with an alternative lender, which to them is like, a death sentence if they're only used to going with A lenders. But if you break down like, hey, this will save you $15,000, that is the motivating factor, not so much that, hey, we're going to put you here because we think it's the best solution. Like you need to be able to quantify how much are you going to be saving the client. So that means you need to have some kind of expectation or some kind of model that's able to simulate variable rate movements, fixed rate movements, and things like that, just to help them give a final answer.
Thank you, Alex. Jesse, what are you doing on your end to adjust or change your product mix to deal with interest rates that are, again, expected to increase in the near future?
So on that end, we're not as interest rate sensitive as some of our other industry partners in the alternative lending space. Again, we focus on short-term loans. Like the bulk of, for instance, we're getting paid out on our portfolio 10% a month. So we got really big turn, and we just want to provide those short-term solutions. And the bulk of it is to real estate investors that are buy, renovate, sell, buy, renovate, refinance, flipping houses. And where we excel is understanding their business and creating offerings that really appeal to them. Also, an offering that really appeals to them is speed. So we at Calvert can turn around a deal same day. And by turn around a deal, we don't mean commit, we mean instruct lawyers. So we have our own in-house legal admin. We, like the larger FIs, typically just instruct one lawyer acting on behalf of both clients and funding the deal. So what we're trying to do is figure out, how do we do it faster? How do we do it better? How do we provide an even better experience for our client? There's always stuff we can do with lowering the down payment. Sure, we can lower prices when the risk is brought down. Another thing we're looking to do is expand our geography. We know that there's a lot of great real estate investors operating in BC, for instance. They've reached out, they want us to be there. So we're doing our research, we're building out the business plan in order to start operating in BC. Some on a kind of strategic side of things, if we weren't as focused on this part of the business right now, I think there'll be an excellent opportunity for the alternative lenders to start doing more seconds. Like, there's going to be a lot of borrowers who are married to their mortgage. They're not going to want to break that, fixed mortgage at sub 2%, which are no longer available. So it's going to be a relatively easy sell when you model out, here's the value of keeping your mortgage and just borrowing a second from an alternative lender. So we can see an opportunity there, but really it's just continuing to focus on what we do best, continuing to focus on the client, possibly expand geographies, and just be laser focused on providing the best possible solutions to our clients.
Thank you, Jesse. And just sort of, from being a lawyer in the financial service industry as well, it's so key, especially when we get money on a loan side, is to get it out fast. It's been less of an issue over the past couple of years, say on a refi where somebody or a business is paying, their rates a lot lower, but as rates increase, for every day you don't get money out, it costs somebody quite a bit of money. Especially when you're getting into sort of multi-million-dollar loans. So speed is key. That we do understand. Joseph, what are your thoughts, or what are you doing in terms of adjusting your product mix to deal with rates that are going to increase here over the next little bit?
Great question, Adam. So, as a software provider that's been evolving from the day we started, obviously the product where it was before, where it is today, it's very different. Literally talking about sort of the things that Jesse mentioned in his previous comment, the second question, you have all these different systems that you have to deal with, one that deals with ingestion of the data, one that deals with putting the documentation together for quicker turnaround. Then you've got systems that need to service that data, then have systems that provide investors their statements and their data and accounting. So what we've been doing is amalgamating all of those things into one platform where companies like Jesse's could eventually utilize one product in one efficient environment. And part of that, and this is where I'm going with your question, we've been talking to clients. We've noticed that private mortgages have traditionally been a fixed rate product because they are short-term products. But given these interest rate hikes, sometimes, especially when you're borrowing money from banks, your spreads could significantly be reduced, and the larger your portfolio is, the more money you're leaving on the table potentially. So what I've started seeing, and we've already adapted to this already, we've already foresaw this coming. So we were already developing all these products in the past year, where we notice clients are giving people the option of fixed and variable mortgages. Now, imagine you have a portfolio as a private lender of 200, 300 mortgages, and half of those mortgages are fixed and the other half are variable. How are you going to adjust rates on 150 loans? How are those investors now going to get updated statements with updated rates? If you're using multiple systems, potentially, you've got to update all that in 4 different places. What we've been able to do for our customers is, just by changing, if they choose a floating rate mortgage product in our system, what will happen is change the rate to prime, and all their mortgages will automatically adjust. Information is sent to investors, to borrowers automatically, based on the rules that our clients create in their systems. And essentially, business as usual. It would take humans hours, days, potentially adjusting portfolios for accounting purposes. We're able to do it with our system within seconds. So literally, if you have 150 loans, you change the rate and increase it by 0.5%, because that's what the Bank of Canada chose to do. All clients' mortgage payments will increase by 0.5%. All investor payments potentially would increase by 0.5%, and all statements for borrowers, their PAD, like EFT, will automatically be adjusted. So accountants don't have nightmares trying to scramble and figure out how they're going to reconcile all this information. So we are doing our part in the space to give our clients an edge in being able to manage this floating rate and interest rate increase environment by offering both a fixed and a variable product, and giving the borrower the choice to choose from a lower variable and a higher fixed, so that they're essentially hedging their bets as the investor. That's sort of our take on the market and what we're trying to do in order to help accommodate our clients in a rising interest rate environment.
Okay, thank you, Joseph. So for the purposes of our panel, I mean, that's the formal portion of this webinar. Now, if anyone has any questions or has any comments or would like to, I mean, ask any of our panel members a question, please, complete the Q&A or put something on the chat. So I don't see anything right now showing up as a question, but we do have sort of a Q&A time now that we can go through some of the stuff. Before we get to some questions that hopefully we'll get, are you finding, and anyone can answer in any order they want, I mean, in terms of a change of demographics in the market, especially with millennials, where we're getting kind of to that age where they are maybe spending more money getting into the industry. Are you seeing that? I know that's maybe more of a phenomena in, south of the border, but I don't know if anyone has any comments on that. If it's sort of business as usual, or you're finding that there is more of a demand, more of a change in that group.
I'll make a quick comment. I would say, I think that it's a little bit different today as like a young couple starting out trying to buy a home, because obviously 15, 20 years ago, even if you made the median income, it was very easy to get in. The mortgage rules are much more relaxed. Banks were more aggressive. Today, what I'm seeing, what I'm hearing is the bank of mom and dad is a fantastic down payment option for a lot of younger couples to get into the market. I think home ownership is still instilled in a lot of families as a very large priority for families to have an asset, something they could lean on, something they could rely on from a retirement perspective. And long-term home ownership has been a solid asset for anyone. And so I think people are trying to get in. Their expectations of what they will own are obviously lower now. People who would expect to own a detached home will either have to move north. If they want to live in the city, they're going to have to either get a condo or a townhome. People are not as obsessed with having big space. I think people are just looking to own something, and they're doing whatever they can to do it. What I'm also noticing, it's no longer a single income, Adam. It's much more dual income. Both people are working hard, and a lot more money is going towards paying that mortgage. But that's the sacrifice people are willing to make, I think, in Canada in order to own a property.
No, fair enough. Does anyone else have any comments? Or
I can add to that. So we work with a lot of first-time home buyers, and so yeah, I would definitely agree with Joseph on a lot of the points he made. I think one thing that's really interesting is there's almost kind of like this clock ticking on a lot of people, because one thing that's becoming more apparent is the only people who really get to buy the detached home are the ones that bought the condo 3 years ago. So what I mean by that is because the average price point, so there's not a lot of cities left in, let's say, Ontario, where the average detached home is under $1 million anymore. So it's like, people struggle enough to get the 75, 100K they need to get to that property. But as soon as you cross the $1 million mark, you need 20%. So your 75K is now 200,000 plus that you need to have saved. So that threshold is narrowing like perpetually, because as prices continue to appreciate, the amount of properties that you can get under $1 million continue to kind of wither. So I see a lot of people get detached homes, like they're not moving an hour or two outside of their city, they're moving provinces to get something more affordable. So for remote workers, anybody that's comfortable with that, it's that works, but it's also not ideal because in a way, a lot of families, people want to be close to their family, people want to be close to home, which is why that bank of mom and dad has an alert, because then like in a way they're kind of giving their kids a down payment to keep them close, or else otherwise they'd probably leave. So it's, yeah, there is this trend, but I think it's only gonna, because the government's given no indication that, let's say, they're going to raise the floor on uninsurable or insurable property prices, which would arguably, inflate housing quite a bit if, let's say, they moved it from $1 million to $1.5 million. So it'll be interesting to see what happens. But for now, it's people kind of sense it where there's not a lot of homes left, and it doesn't show any signs of slowing down. So yeah, people are kind of rushing to get in, and they really believe that the long-term goal is to build wealth. And for the most part, people do build wealth in the long term as a homeowner. But yeah, it's just tougher and tougher to get the property you want at a price point that's below $1 million.
Unless you come to the prairies, right, Adam?
Exactly.
You can still get a really nice single family detached home for 500 grand in both Calgary and Edmonton. And anecdotally, Alex, you had mentioned them moving provinces. We've been actively hiring here for over a year, and we're seeing a lot of very talented young people who are passionate about home ownership, wanting to take roles here at Calvert Home Mortgage because they want to own house, and they can come to Calgary and have we can give them that median income, and they can live comfortably in a $500,000 bungalow with a 50-foot front lot, 15 minutes from downtown. I know I'm plugging Alberta here, but there are still some really great places to live in Canada that are affordable.
No, and I would say any of the prairie provinces for sure. I mean, Saskatoon, is a smaller city, but actually some of their prices are actually quite high, but that's just more of the size of the city and sort of the demographic and economic makeup of the city. But a place like Calgary or Edmonton, even Winnipeg, I know if you're from Toronto, it's Winterpeg, and you think of the prairies of being very cold and flat, both kind of true. Calgary, of course, is sort of more of a hot spot in terms of they get the Chinooks in the winter, which is great. Edmonton doesn't, so Edmonton's a lot colder. Yeah, there's lots of value in these markets still, and it's not Vancouver or Toronto out here. So when you talk about $1 million, entry level in the GTA, you're looking at, $1 million home here. While it's not unusual, you're looking at top tier, top neighborhood type home, and typically you can buy on average not even a starter, but sort of that next step up from a starter in that 450 to 550 range, in a new area with all of the amenities, with new schools and the other support service in there and infrastructure.
I think wherever anyone goes, it's all relative to each situation, right? Like, you talk about Calgary and how it's 500, and I'm in Kelowna. Like, the average house in Kelowna is well over $1 million now. But a lot of times, I know some people that have moved here from Toronto. I'm a born and raised Kelowna guy. Like, I remember my brother buying a house on the same street I live on, which was like $400,000, and now it's well over $1 million, and that's only like 7 years ago. Whereas I've had friends that have moved here from Toronto, and they've went and bought that that house that is 4,500 square foot house on the 0.1 acre lot. They have no yard, and I'm like, why would? But they spent like $1.5 million on it. To me, that just seems so crazy. And I'm like, why would you do that? And his comment to me was, well, he's like, because I bought that house at 65 cents on the dollar. In his perspective, right? But you talk about that as a Kelowna boy growing up, I'm like. And my comment to him was like, you bought it at 65 cents on the dollar, but to anyone that's lived here for the last 10 years, that's like $2.50 for that same dollar. It's kind of the way it works out. So it's all relative, no matter where you come from, really, is where you're going, because it's, Toronto to here to Kelowna seems like really cheap. And then from Kelowna to Calgary seems really cheap. So just depending on where you really want to land.
Yeah, no, very true. Very true.
Yeah.
And actually, just to comment on that very quickly, it's funny because in our through our portal, people can start home buying plans, and more, like I'll see clients starting sequential ones where like they're simultaneously looking in, let's say, I had a client literally just last month, he was looking in Kitchener or Calgary, which are like nowhere near each other. And he ended up going with Calgary. So it's, yeah, I'm seeing that a lot more where it's not like I'll look into a couple cities that are driving distance from each other. It's I'll look into two different cities that could be like an airplane between them kind of thing.
Well, it goes back to that whole like hybrid model versus work from home model that everyone has now, right? And everyone is like happy. Like Kelowna is like one of those places, and anywhere you go is one of those places where you no longer need to live, work, and play in the same city. So if you can work out of Toronto and go play somewhere else, it's like there's a lot of people that are doing that, or Vancouver or wherever else, right? Like you're seeing way more and more and more and more of that now. So.
From a definitely from a creativity point of view, and you could live in a warm climate and work in a northern climate, and nobody would frankly know, especially if you don't need to necessarily see people on a daily basis. So we're at 27 minutes after the hour. I haven't seen a question or a chat comment come in. So we're sort of rounding up the hour. I don't know, Danielle, I'm sure you're on if you want to come back on and conclude.
Yeah. That sounds great. I just want to thank you all, of course, for all your incredible insight, and obviously to Adam for moderating this discussion. You covered obviously so much in the hour, a lot of information. And so for everyone who did tune in, there's lots to digest. So if you do have questions following the webinar, feel free to reach out directly to any of the panelists here. I'm sure they're happy to follow up with you. And you will be emailed out a recording of this webinar to watch again if you need. We also encourage all of you to join us as a member of the CLA and participate in the FinTech lending community, and of course to continue attending our upcoming events. There's lots coming up, and you can find them at lendersevents.com. So with that, I'm going to close out and thank everyone for joining today.
Thank you, everybody.